Hey there, it's Mitch. Welcome to the live stream. Be the boss of your money. Let's just give a quick shout out to Nvidia. This is what many consider the signal that investors needed to be comfortable continuing to own stocks whilst they make new all-time highs in terms of the three major indices, the Dow, the S&P 500, and the NASDAQ composite. So what's the big news? Nvidia, another astoundingly amazing quarter. The march to adapt artificial intelligence in the world of technology continues apace. In fact, it looks like it's accelerating. Nvidia announces a 10-for-1 stock split, and the stock is trading at over $1,000 per share in after hours trading. And given the growth, it's really all the arguments about the stock has come too far too fast. I think that has pretty much evaporated those arguments. But you do have to hold your breath when you buy a stock that is up over 240% last year and up about 100% this year, and you're going to buy more. But that is the nature of investing in growth stocks. We'll talk about that, why the market was down, a little bit about what's happening with inflation and Fed rate cuts, et cetera. So I'll just roll the intro real quick, and then we'll just have a nice quick show, and I'll be out of here. Stick around. This is going to be interesting, and we all want to just know what's going on. Here we go. All right, thanks for joining me. So the big story in aftermarket trading, and I normally don't get into aftermarket trading stories unless it's something significant, like in this case, it is the announcement of Nvidia. A lot was riding on their earnings announcement because artificial intelligence is, enthusiasm over artificial intelligence, the growth prospects for the stock market, for corporate earnings. That has been a big driver of the overall stock market averages. By the way, you cannot invest directly into an index, but you could invest into a security that tracks or mimics an index. So Nvidia knocks it out of the park. They're going to do a 10-for-1 stock split. The stock is trading at over $1,000 a share for the first time. And this is very exciting. And again, like I said in the intro, I think this quells or stops in the tracks those arguments that the stock has come too far, too fast. Given the growth rate, given the runway they have, given the leadership position they have, it's quite easy to justify this stock going up a lot more than it has now. It's also easy to justify saying you could take a little off the table. You may be up in it a lot, and taking a little off the table is nothing wrong. There's nothing wrong with that. Eventually, a stock will go up as much as it can go. Eventually, a stock, or I should say, eventually, the underlying company will have eventually wrung out their full potential of profit potential. They'll have wrung it out. Eventually, markets change, investors go for another puck. They start to see technology change, obsolescence shows up, and all of a sudden there's a new kid on the block with the new technology and the shiny new thing. I know that because it's happened before. I remember the days when Cisco was the darling of the stock market. Intel, Cisco, Sun Microsystems, Lucent. The only stock that I can think of that has regained its former glory from the tech bubble of the year 2000, it's Microsoft. It's the only one. None of the others are really even worth talking about as far as investors are concerned. But these things happen, so maybe Nvidia is the next Microsoft. But remember, Microsoft had to go through the same hell that the rest of the NASDAQ went through for a couple of years to get to where it is now. So having said all that, that time eventually is not obviously today and it's not tomorrow. No guarantees, of course. But the good times are rolling. And when you see companies like Facebook and Uber and Amazon and everybody else who's big in technology and Tesla, they're all gunning for artificial intelligence to make their products, their computers, their cars, whatever they make, they could work better, they could work faster, more accuracy, better against the competition, and eventually everybody has to have it. Think about the early adapters for the internet. Companies that adapted to the internet first movers, had big stock premiums. But now every company is on the internet. In fact, there's no such thing as a company, as far as I know, that's not on the internet. And it'll be the same thing with artificial intelligence, but this is a multi-year runway. Having said that, if you have Nvidia, let's say 100, $200 a share, or of, let's say, a very low price, and it's up a lot, there's nothing wrong with taking a little bit of profit too. So how would you think about taking a profit on a stock? Let's talk about that. If a stock becomes too big a portion of your portfolio, so maybe Nvidia is now 20 or 30% of your overall investment portfolio. Now, this is personal finance 101. You might be okay with that. Somebody else might not be okay with that. If you're not okay with that, then you are free and clear to sell down some Nvidia. Maybe get it down to 15, 10, or 5% of your overall portfolio. That is a decision you have to make. And that's why it's important to have an investment strategy. And if you don't have a strategy, I would suggest to either find one, figure it out, or you can reach out to me and I'll be happy to help you with your investment strategy. You know what? That's what I do. That's why my firm is called Client First Strategy. Right. I like how I just tied that all in together and I didn't even do it on purpose. Okay. So if a stock is too big a portion of your portfolio, that's a good reason to take some gains off the table. It doesn't mean you sell every stitch of share you own. You could hold on to a lot of it. Maybe if you want to invest in other sectors and your portfolio is now looking like Meta and Amazon and Alphabet and Nvidia and Microsoft and Salesforce.com, ServiceNow. There are so many large cap Uber, so many large cap tech stocks that have done well. And it's quite common for people's portfolios to look like, tech portfolios. So maybe that's a reason to sell some of these stocks that are up a lot and use that money to diversify into another sector. There's healthcare, there's financials, there's materials, there's consumer staples, consumer discretionary, there's utilities, there's energy, there's real estate. There are other places to put your money for a decent potential long-term return. That is what investing is in large part all about, right? So let's take a quick look at the screen. Okay, let's take a look at that. I popped myself out. Hold on a second. All right, here we go. So Nvidia is 1,006 aftermarket trading. Will it be here tomorrow morning? It's really not possible to know. I suspect it will, but it's not possible to know. I hope it is because I think it's exciting. But it's up 6% aftermarket trading. So you're going to, if you have a share of the stock, I don't know. I didn't look at the exact split date, but soon you'll have 10 shares of $100 stock instead of one share of $1,000 stock. This will make it a lot easier for people to take some gains too, because if you only have like 5 shares, you don't want to maybe sell 20% of your portfolio by selling a share. So now if you go from 5 shares to 50 shares, maybe you only sell 3 or 4 shares, that sort of thing. But you need a strategy to decide. What's another reason to take some gains on a stock like this? Well, you could take it just because it's up. You could say, well, when I get a stock that goes up a lot, I like to take the money that I invested in it and take that out and put it into something else and let the profit keep running. That's another way to go. I don't know if it's the best way or not to go. Another way is to maybe use a trailing stop order. So you put a trail, let's say if the stock goes down 3% from its current price, your limit order would turn into a sell order. So a limit order that's 3% below the price of the stock. And it could be trailing. So if the stock goes up more, your limit order goes up. It's still 3% below the current price of the stock. But if the stock price goes up, the limit order price will also rise. So it kind of keeps going up and acts like a valve. When the stock goes down, it gets you out. So it could be a market order. Your limit order could turn into a market order, another limit order. There's a lot of ways to do this. So these are ways that you could take gains in a stock and maybe protect some of the gains. None of these ways are perfect. And if you really need to take a gain or book at least some profits in a stock that's up huge for you, the best thing could just be sell a little bit of the stock. I don't know if it's 5 or 10 or 20% or whatever. It's different for everybody. These are the things you talk about. Let's talk about quickly the stock market. So the Dow was down 200, and I saw the headlines. Oh, Dow down over 200 on inflation concerns. The Dow being down 200 points is not really, to me, anything to get excited about. NASDAQ was off a fractional of a percent. S&P was off a drop. And that's just because investors were waiting to see what the earnings numbers would be for Nvidia. If Nvidia disappointed, we'll look out below. That would probably mean a hit for the overall markets and for the overall tech sector, especially for the tech sector. But that's not the case. Oil remains 77 and change. The VIX is about 12. Why did the market? Oh, and interest rates were modestly the same, stable. So why did the stock market go down? Because inflation worries. The Fed said from their minutes from the last meeting that they unanimously agreed to hold rates steady. Some Federal Reserve officials think that maybe a rate hike could be in store. Although I think the general consensus that most, including Chair Powell, do not want to raise rates. It doesn't mean that they want to cut them right now, but they don't want to raise them right now either. But we'll see what the figures look like. But investors, I think, we're hoping to see a more dovish Fed that would get closer to cutting. So right now, odds are of 1 or 2 rate cuts this year stand. I never bought into the thought or the predictions that the Fed could cut rates 6 times this year. I always thought that was excessive. From the very beginning of the year, I said, I think we could see maybe 2 cuts for the year. Well, maybe it'll be 1 or 2, but I'll take that. Eventually it'll add up. But right now, investors are just not getting the lowering of interest rates that they thought they needed to keep stocks going higher, but they are getting higher earnings from the biggest companies that really count. That's what's happening in the market, and I'm so glad you could join me today, and I'll be back tomorrow. If you have any questions, hit me up in the comments. You can always send me a DM, and if you're watching this in the live stream, great. If you're watching it in the replay, that's great too, because once I do the show, they stay in my timeline. And of course, if you don't mind, give it a thumbs up or a heart or some other reaction, depending on which social platform you're watching on, because it helps spread the word, helps the cause, and your other connections will possibly see the show and maybe follow us as well. And I'd really appreciate that. Okay. Have a good night. Thank you.